What's up, you guys? It's Graham here. Now, normally I would never make two Robinhood videos like this back to back, but I gotta say, this entire event has just been extremely mind-boggling. There have been some new events that have just come up over the last day, and I felt like there's a lot more that needed to be said about what's going on. Because pretty much every major business publication out there has picked up on this story. Robinhood still has not addressed the core issue of what's going on, and other people have decided to exploit this loophole even further to new extremes. In fact, before I posted my last video, the Reddit user Moon Yachts was able to use this cheat code to leverage a $4,000 deposit into a $1 million position by buying 120,000 shares of Ford stock. And then after that, the Reddit user Call Warrior, who had a personal risk tolerance that was much higher than that, turned a $3,000 deposit into, wait for it, a $1.7 million leveraged position in AMD. Meanwhile, Robinhood's fix was to disable low strike call options, but that still meant you're able to leverage way more than you're supposed to. It's just no longer infinite anymore. And so far, at the time of me filming this video, they've only issued the statement saying that we're aware of the isolated situations and communicating directly with customers. So let's go over exactly what this means for Robinhood, how this might affect their future IPO, what I think about the entire situation, and also just how they make money in the first place. You know what, let's just start there. How does Robinhood actually make their money, especially if they give their users infinite margin? Now, to start, it's absolutely no doubt that Robinhood changed the entire investment industry for the better, and their come up has been nothing short of spectacular. They launched in late 2013 with a non-leveraged investment of $3 million. Their premise was really simple, just offer an easy mobile platform to trade stocks on with zero commissions. See, they found that actually executing a stock trade did not cost a brokerage that much money. So that meant that brokerages were just upcharging and making a ton of profit every single time you bought and sold a stock. So Robinhood just decided to eat the cost of actually executing the trade, which was not that much money to begin with, and then just run a smaller, leaner company that would just balance out the lost revenue. Their goal was not to make a bunch of money from each user, but instead get a bunch of users and make a small amount of money from each of them. Initially, the app was only launched as a stock tracker without the ability to actually go and buy and sell stocks. And it also offered a way for people to comment and share their thoughts on which stocks they thought would do well. Within 8 months after that, they got regulatory approval to act as a brokerage and offer its users the ability to buy and sell an unlimited amount of stocks, all for the low price of $0. Now, that was such a revolutionary and popular concept at the time that they got 10,000 signups within the first 24 hours. Then by mid-2014, they had over 500,000 people signed up, with 80% of those users between the ages of 18 and 29. So by the time they actually launched, they had over 1 million users signed up on their wait list, which was absolutely staggering considering that this had not been done before and it wasn't even functional yet. So this proved that there's enough demand for the concept to go wildly successful, and it did. Within 2 years after that, Robinhood received $110 million worth of funding by DSD Global, which valued the startup at a whopping $1.3 billion. Then in August of 2017, the unthinkable happened. They started offering free stocks as a referral for signing up. Which, by the way, is a perfect time for me to plug that if you sign up for Webull using my link in the description, they will give you 2 free stocks when you deposit $100. One of those stocks is going to be valued up to $1,000. And they're going to be giving you a $5 Starbucks gift card. The promotion is ending soon, so if you're interested, use my affiliate link down below in the description to sign up. But seriously, real talk here, I think we could attribute this whole free stock concept all the way back to Robinhood. Prior to them, no one was going and giving out free stock referrals like this. And the reasoning for this was pretty legitimate because other companies would offer you a free service as an incentive for signing up that led you to know what they did. Like Uber will give you a free ride, or Airbnb will give you a discount on a stay. So it made sense that Robinhood would just offer you a free stock as an incentive for signing up on their platform. And you can't argue with results after that because it worked. They currently have over 6 million users and a current valuation of $7.6 billion. But in terms of how they make money, it's a little bit uncertain because they're not a public company yet and they don't need to disclose whether or not they're profitable or just how much money they're making. But it is estimated that they make money from their 6 million users in these few ways. 1, they make money from their Robinhood Gold service, which begins at $5 a month and offers you additional features like unlimited margin trading sufficient to your own risk tolerance. Just kidding. Secondly, they charge a 5% interest rate on their sufficiently leveraged margin accounts, which again, 5% adds up. Third, they make money from your uninvested cash on the platform, and banks do the exact same thing. They'll use a portion of customer deposits towards very safe, low-yield investments and then profit the difference. Now, fourth, and probably the most controversial, is that Bloomberg says that almost half of Robinhood's revenue came from a practice of routing order flow. Now, this is the practice in which Robinhood itself does not execute the stock trades when you place them, but instead they outsource it to another company who pays for the right to execute those trades. Those type of firms usually make a very, very small amount off the trade. According to Bloomberg, that was 0.0024 cents per share, but with $150 billion worth of stock trading volume, it adds up. Now, even though this is very common practice for brokerages, there was some controversy in terms of how this was done. Some saying that Robinhood was selling order flow to high-frequency trading firms that paid more money and didn't get you the best price possible for a stock. Now, I know some people are going to be up in arms about this, but my opinion is that it's not that big of a deal, and we're talking about such a small percentage here. You should be more worried about picking off a dime off the sidewalk when you see it than worrying about paying a fraction of a cent more for Robinhood's order flow, but that's again just my opinion. Besides that, I'm sure they're eventually going to be charging some interchange fees from their debit card associated with their cash management account, and I'm also pretty sure they have a few other things that are probably in the works, like maybe hopefully we'll see a retirement account. And I have no clue if they're actually profitable as a company and whether or not they plan to expand in other banking services like checking accounts, loans, credit cards, and stuff like that, which I have a feeling that is going to be whether or not Robinhood sinks or swims. So with that said, I think it's no surprise that their end goal is to result in an IPO. After all, it seems like an inevitable fate of many startups who might have a difficult time getting to profitability, and when investors get antsy to cash out and give their shares to the public, it just seems like the most logical solution. But in my opinion, a few issues here certainly make it a little bit concerning. One is their fairly large mishap with the SIPC over their proposed checking and savings account. Basically, a year ago, they wanted to create a checking and savings account with no fees, no minimums, that also paid you a 3% interest rate. Now, since they were not technically a bank, they would not be FDIC insured, but they did claim that SIPC insurance would be covered under their brokerage, which covers investment accounts. Well, it turned out they were wrong, and SIPC never agreed to cover any of their checking or savings accounts. The entire thing was just a massive PR disaster. Robinhood scrapped the idea, said that they were going to be revamping it, and then they tried to sweep it under the rug. Now, I get it, mistakes happen, but it was concerning to me that a company as large and valuable as Robinhood, who spent all of the time to create a checking and savings account, would not first confirm with the SIPC that this was indeed covered before announcing it. Now, secondly, how they're handling this margin glitch is, to me, a little bit concerning. This has been a bug that people have been publicly posting about and abusing for quite some time, so it has to make you think, if we're only now just hearing about it, how many other people have been doing this and defaulting on their payments and then just never posting about it? And how much action did Robinhood really take to prevent this from happening in the first place, or try to fix it sooner? Now, I could be wrong here, but I have a feeling this could just be the tip of the iceberg in terms of what people are doing and abusing, and then just not posting about it. Now, like I said, mistakes happen. No one is perfect. No company is perfect. We all make mistakes at some point, and that's no reason to fault or shame a company. But I think what does matter is how they handle that situation and the speed at which they address it. Now, in their defense, I have no idea how difficult of a process this would be to fix or how long it would take to address it. And I agree, if they were to make a very large statement about this before the issue is actually fixed, it could draw more eyeballs to their platform and maybe encourage more people to go and abuse it. But I do think this was such a large issue that should not have happened in the first place, especially with people publicly posting about it for quite some time. You think it would be on their bucket list just to fix this sooner. Not to mention, this spread worldwide within about 24 hours of it being posted on Reddit. And the glitch at the time of me filming this has not entirely been addressed, although they have made an effort to curb people who are trying to abuse it. Now, this worries me a little bit about their ability to fix and address other glitches if and when they arise in their entire platform. Especially if their end goal is to IPO, it doesn't exactly instill confidence. In terms of where we go from here, ideally Robinhood just fixes the glitch and sweeps it under the rug, and then keeps a very close eye out on everyone else just to try to make sure they're not trying to take advantage of any loopholes. In a weird way, Wall Street Bets was probably the best user testing Robinhood could have ever asked for, because only they would find a glitch like that, exploit it, and then bring it to light in such an ostentatious way. But how they handle those issues is going to be an indication of how they will handle future issues as well when they come up, which I think is inevitable, and it's going to happen to every business out there. I also think brokerages and any investment app out there should really be monitoring social media sites like Wall Street Bets very, very, very closely. The same also applies with YouTube. I think a lot of major brokerages out there are just sleeping on this information information and relying on old school, outdated user feedback resources that just really no longer apply. I was even surprised when I went to a financial networking event a few weeks ago and several very large companies, which I will not name, had no idea that finance content even existed on YouTube, and all they wanted to know about was what my financial blog was. That goes to show you that many of them are years behind where they really should be. Lastly, I would not be surprised that after this, Robinhood and many of the other brokerages out there would change the way that margin accounts are handled. Because realistically, there's no rational reason why everyone is just given the same access to margin. For the most part, all you need is $2,000, pay for Robinhood Gold, agree to pay a 5% interest rate, and bam, all of a sudden you could borrow 50% of your money to go and invest with. Pretty much in no other industry would you be able to do that. So it doesn't make sense to me why this would be the case for stocks without more thorough of a background check. Finally, let me say this, I have nothing against Robinhood. I use them myself, and I think they're a great platform. If it wasn't for them, I have a feeling that none of us would be seeing free stock trades like we are today. We almost certainly owe that to them, and they've shaken up the entire investment industry for the better. They've definitely got some room to improve, customer service being one of them, and the ability to actually call and reach a live person 24/7 would be huge. And maybe they might need a more thorough and PR research team to scour the internet, see what people are saying, find flaws, and address them before they get as big as this. Otherwise, you're just gonna have people with nothing to lose and everything to gain by trying to take advantage of these little loopholes and glitches at Robinhood's expense. And with a potential IPO coming up in the future and competition at all-time highs between them and pretty much every other brokerage, I think it's more important than ever to go on the offense, bring out new features, improve the existing platform, and make sure errors like this are resolved as swiftly as possible. So with that said, you guys, thank you so much for watching. I really appreciate it. As always, if you guys enjoy videos like this, make sure to destroy the like button and also destroy the subscribe button and notification bell so YouTube notifies you anytime I post a video. Also, feel free to add me on Instagram. I post there pretty much daily, so if you want to be a part of it there, feel free to add me there. Also, add me on my second channel that is known as The Graham Stephan Show. I post there every single day. I'm not posting here, so that means if you want to see a brand new video from me every single day, make sure to add yourself to that. Thank you so much again for watching, and until next time.
That sent me, I'll be honest. I was like, holy like, they've actually done something in my account now, and now I have an official margin call for over $250,000. And then that disappeared. And then my, as they were closing the account positions, my account balance shot up all the way up to $752,000. You know, so it was all over the place as they were like cleaning up the mess in my account.